Tired of dropping your phone or struggling to prop it up? Meet the Pop Sockets phone grip with expanding kickstand in black, your new must-have accessory. Don't miss out. Grab yours today. Click the link in the video description to shop now on Amazon.
Imagine a world where governments can finally break free from the shackles of high interest rates and debt. A world where they can tap into the power of digital money to finance their operations without sacrificing control over their fiscal destiny. Welcome to the realm of bit bonds, a game-changing concept that's poised to disrupt public finance as we know it. The idea behind bit bonds is simple yet revolutionary. Imagine allocating a portion of your nation's debt to Bitcoin, the world's most popular cryptocurrency. That's right, folks, Bitcoin, the same asset that's been touted as a speculative haven for the wealthy and reckless. But what if I told you that with bit bonds, governments can benefit from the upside potential of Bitcoin without exposing themselves to the usual risks of loss or custody challenges? It all started when the U.S. government realized that its traditional approach to managing debt was no longer tenable. With interest rates skyrocketing and fiscal deficits soaring into the trillions, policymakers were at a loss for how to bridge the gap between their spending ambitions and their limited financial resources. That's when they turned to Bitcoin, or rather, the concept of bit bonds. The idea is to allocate a small portion of the nation's debt to Bitcoin, with the understanding that the government will split any gains with the bondholders 50-50. It's a clever play on the usual Bitcoin narrative, where investors are expected to bear all the risk and reap none of the rewards. But what if the government takes on that risk? What if they use their collective might to drive up the price of Bitcoin, creating a windfall for themselves and their citizens? To illustrate this concept, let's consider an example. Imagine a 10-year bond with a face value of $100 and an allocated portion of $10 to Bitcoin. If Bitcoin doubles in value over the period, that $10 becomes $20, and the holder might end up with a total value of $130, $110 principal plus $20 additional value. That's a tidy return, folks, without any of the usual risks associated with investing in Bitcoin. But it gets even better. As we scale up the size of the bit bond issuance, the interest savings become staggering. According to the scenario outlined in the article, if the U.S. government were to issue $2 trillion worth of bit bonds, they could save an astonishing $700 billion over 10 years, not accounting for the cost of buying Bitcoin. Now, I know what you're thinking. This sounds too good to be true. But bear with me, folks. The implications of bit bonds go far beyond just interest savings or gains from investment. This concept has the potential to reshape public finance as we know it, allowing governments to tap into the power of digital money without sacrificing control over their fiscal destiny. Institutional investors, like pension funds and insurers, are already taking notice. They see an opportunity to deploy significant capital into a low-risk asset that's closely tied to the U.S. government, which is roughly equivalent to having an AAA credit rating. And as more institutional players get in on the action, liquidity and pricing will improve, creating a robust market for bit bonds. So what's next? Will policymakers take notice of this groundbreaking concept? Only time will tell. But one thing's for certain. If governments can tap into the upside potential of Bitcoin without exposing themselves to risk, we'll be witnessing a seismic shift in public finance that could have far-reaching consequences for economies around the world. The future of public finance is here, and it's looking more exciting by the minute. Join us on the Bitcoin Bulletin as we continue to bring you the latest updates, insights, and analysis on all things Bitcoin.